Hi, I'm John Stewart, Chief Investment Officer of Farmers Trust Company. This is the Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Hi, I'm John Stewart. Welcome to the Investor's Edge. First up, the week in review. Market struggles to gain traction despite tamer inflation. Well, we had some really encouraging inflation reports this past week. The annual inflation rate fell to 3.5% year over year in June, which was down from 4.2% in May and below the 3.8% forecast. So a drop was expected based on the falling oil prices we saw last month, but it fell even more than expected. Core inflation, which excludes food and energy, fell to 2.6% from 2.9% in May. And final demand producer prices actually fell 0.3% in June, which should be very helpful to corporate profits and, of course, the stock market. But after an initial positive reaction, stocks quickly sold off, and the S&P 500 index is now lower over the past week, while the Nasdaq has performed far worse with some AI-related names coming under pressure and is now down more than 2% in the past 5 trading days. So what gives? Well, renewed hostilities with Iran have oil prices moving back up, and that could easily lead to higher inflations going forward. There's also some concern that the economy is showing signs of slowing down. So also, keep in mind that August to October tends to be the most volatile 3-month stretch of the year. For this week's featured insight, past is not always prologue. Investors are starting to get pretty comfortable with fairly high rates of return on the S&P 500 index. Many believe that just buying and holding the S&P over the long run will virtually guarantee roughly 10% returns in perpetuity. And it's been running closer to 15% over the past 10 years. Now, while all that sounds wonderful, past performance is no guarantee of future results. And the S&P 500 index itself actually has a long history of going through long periods of underperformance. In fact, the S&P tends to produce 10 to 15% average returns for about 15 years or so, followed by periods of flat to slightly down returns for 10 to 15 years. Then the cycle repeats. Well, we've been in a bull market for the past 17 or so years now. Something to be aware of when making your financial plans. Looking ahead, earnings season heats up. We've already had some early earnings reports from the major financial institutions like JP Morgan and Goldman Sachs, and on the whole, the reports have been quite good. Earnings season will really heat up in the coming weeks with a lot of the major tech firms scheduled to report by the end of the month. One thing to keep in mind is that earnings expectations are sky high. In fact, by one measure, earnings growth forecasts for the S&P over the next 3 to 5 years are as high as they've ever been. Now, companies will likely report good earnings, but high expectations make it harder to beat, and some firms may be uncomfortable with the unusually high forecasts going forward. This could lead to some disappointment in some of the forward outlooks, as earnings guidance gets revised for the second half of the year. Once again, I'm John Stewart. Thank you for watching The Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.